So tomorrow the Bank of Canada makes its next rate decision. And if you're like most people right now, you're probably turning on the news and you're seeing all kinds of stuff happening. And you're wondering, where the hell are we going to go from here? Because on one hand, you see that inflation is coming down, but then you see that in February we lost 83,000 jobs. Oil prices are $1.60 a liter, and somehow the mortgage rates are still around 4.5 to 5%. So naturally, the question becomes, are rates going to go up, or are they when are they going to come down? But here's the question that I actually want you to think about as we go through this. If rates stay or if they go up, and a lot of homeowners are going to be facing refinancing this year from lower rates to much higher rates, what happens to the prices in the spring and what that actually means for the market? Let me walk you through this in a way that actually makes sense with no jargon or assumptions, and I'll show you how it all connects. So in this video, you're going to learn where the rates were during the pandemic versus today, what happens with inflation, jobs, oil, and the economy and how it affects the housing market, why mortgage rates aren't dropping as fast as everyone wants, and at the end of it, I'm going to answer the big question. If spring 2026 is a good time to buy or sell, or to just wait on it. Now, before we get into it, if you want to actually understand the real estate market and not just the headlines, hit the like and subscribe button. Turn on the notifications because it helps people like you get information like this. My name is Jonathan Renna. I'm a fully licensed realtor working in this GTA for Keller Williams, and I have conversations like this every single day with my clients. So let's start with something simple. Back during the pandemic in 2022, 2021, the Bank of Canada dropped its rates to basically emergency levels. Everyone remembers it. Money was free. The rate was 0.25% for people who want to know. And that's as low as it gets. And what that did is make borrowing incredibly cheap. And carrying debt was very, very cheap. Variable rates were super low. Fixed rates were about 1.5%. And that's the environment where all of the prices in the housing market exploded. Not because people suddenly got rich, but because they could afford way more debt on a monthly basis. Now fast forward to today, we're still sitting at about 2.25% after having gone through all of this yo-yo rate hike up to 5% and all the way back down. That's a massive swing in just a short amount of time. And what that does is it completely changes people's behavior. When money is cheap, people stretch. They take on more. They compete harder. When money gets expensive, everything tightens. Qualifications get harder. Payments go up. And people hold on to their money. They hesitate. That's the shift we're sitting in right now. And then you layer inflation on top of that. So back in 2022, inflation in Canada hit around 8%. I mean, that's extremely high. And it wasn't just a number on a page, because it was felt in the groceries, in the gas, in just the everyday common goods that people were purchasing. That's what forced the bank to raise the rates aggressively in the first place. Now today, we're sitting closer to about 1.8%. So on paper, it looks like the problem is solved. But it's not that simple. Yes, inflation has come down, but your cost of living hasn't. Food is still 21% higher than it was, and everyday life still feels really tight on your wallet. And now put oil into the mix, which is, oil just has a way of feeding back into the loop. So the bank is in a really tricky spot. We've slowed inflation, but they don't want to cut too fast and accidentally bring it right back. And this is where oil becomes really important, because during the pandemic, oil, a barrel, dropped all the way down to $20 to $30. There was no demand for it. The supply chains were disrupted. But now we're pushing it back up to $100 a barrel. And this is where you feel that oil touches everything. It touches your transport, your food costs, your goods. It touches the entire economy. So even though inflation looks under control, there's still pressure building underneath it all. And now let's look at the jobs. So because this is where things start to kind of shift in a real way. Not long ago, unemployment in Canada was sitting around 6.5%. And it's not great, but it's stable. Then in February, we lost 83,000 jobs, pushing unemployment up to 6.7%. And these weren't random losses, obviously, and a lot of them were tied into the manufacturing and the trade industries that are very, very sensitive to what is going on with the US tariffs. So when businesses start pulling back, hiring slows, layoffs happen, and people get cautious. And when people get cautious, they don't make big decisions like moving. They don't upgrade their homes. They don't stretch themselves. They wait. That directly affects the housing demand. And if you zoom out even one more level to look at the economy overall, the healthy economy grows at about 2 to 3% a year. Now we're sitting closer to 1.1. So we're not in a recession, but we're definitely not in a strong growth environment either. And that's because everything we're talking about, the higher rates, the weaker spending, the global tension, the businesses holding back, it's just all connected in a loop. Now, here's where a lot of people get tripped up with the mortgage rates, because they assume that if the Bank of Canada holds or cuts the rate, mortgage rates should just drop. But unfortunately, that's not how it works. Variable rates, yes, they follow the bank, but your fixed rates follow the bond yields. The bond yields are reacting to inflation expectations, the global markets, and economic uncertainty, not just the bank's decision. So even if the bank pauses, fixed rates can still elevate, bond yields stay high. That's why people are confused right now. The headlines say one thing, but their mortgage quotes say another. So now let's bring it all together. You've got borrowing costs that are still high compared to where they were during the pandemic. You've got job uncertainty creeping in. You've got slower economic growth. You've got bond yields holding fixed rates up right now. And at the same time, you're starting to see inventory hit the market. More listings mean more competition for sellers. And when buyers are already hesitant, that creates downward pressure on pricing. So going back to my big question, is 2026 a good time to sell or wait? Now, if you're a buyer in this market, then I would say yes. But go in with your eyes open, because home prices can still drop, even if rates don't go up. And if you're a seller and you have to sell, then make sure you have a home that stands out from the crowd a lot, with a good strategy, pricing, and appeal. Because rates aren't just one piece of the equation. What really drives the market is a combination of affordability, confidence, and supply and demand. And right now, that combination doesn't point to a market that we're used to seeing at this time of year. It points to a market that is tentative and very seller heavy. So tomorrow's Bank of Canada decision matters, but it's not the full story. The real story is everything happening underneath. The jobs, the inflation, the oil, the bond yields, and how people are actually feeling financially. And if you're making a move this year, if you're buying, selling, or even renewing your mortgage, you need to understand how all of this ties together. Because in this kind of a market, the difference between a good decision and a bad one is $50,000 to $100,000. And most people don't even realize it until it's too late. If you want help navigating it properly, go to my website. I've got all of the information there for free about this topic. You can download my guides or you can book a strategy call. The links are all in the description. We will walk you through your specific situation and make sure that you're not guessing your way through one of the biggest financial decisions of your life. My name is Jonathan Rena. I'm a fully licensed realtor working for Keller Williams in the GTA, and I will see you in the next one.